Let's also connect with Deven Choksey to get a better understanding of the fundamental setup. Deven, good morning. Thank you for joining us. Deven, things are looking slightly rusty. Do you think the trending move, the thrusting move for the Nifty is over? And now in the run-up to the election, we could see more choppiness and a lot of volatility?
Good morning, Nikunj. Well, I think what we are currently seeing in the market is more of a predictive behavior of the market. I think if this particular market has slipped into some kind of a correction, somewhere I think in the beginning of the month itself, I think it was known that in the second half of April, probably before the expiry of the April contract, I think you would see the market slipping into some sort of a correction. And this correction is not very surprising, given the fact that we have a major event ahead next month, in the middle of the month, as far as election outcome is concerned. The market had to create some kind of a headroom, and that's where I think this correction is justified. To my mind, I think the FIs have basically, I think, stopped buying at this point of time, or to a certain extent they have moderated their buying process. I would say that I think market would probably remain into some kind of a sideways corrective zone. Maybe I think Nifty could correct, I think, to somewhere around 6650 to begin with, and if it is further going down, then it is around 6600. But I think that around this level of 6650 to 6600, you would probably see the market buying returning back into the market. And that's where I think one would probably select few of the quality stocks into the portfolio, where I think in the corrective downside, you might end up getting good quality stocks with a good amount of headroom. This game is largely, I think, to capture the faster gains ahead of this event, and that's what this market is doing. So maybe 6650, 6850, 6900 kind of levels could be the levels in which market should be operating going forward till election period.
Let's talk about Infosys. There was nothing wrong with the guidance. Yet after a gap-up start, Infosys yesterday retreated by about 4% plus from the day's high. If the guidance was not that disappointing, what explains yesterday's price action?
Well, Nikunj, I think largely the guidance is remaining on a lower side compared to, I think, the peers in the industry, and particularly TCS. TCS has been extremely confident, and probably I think they have been talking about the growth rate, which is double the size of the growth that Infosys is recording. And that's where I think the industry players have probably, I think, stayed focused on TCS. The TCS trades at a premium to the market, but this premium is justified because they are basically getting this premium due to the growth that they are producing into the business. So as we are likely to see the numbers of TCS today evening and the management commentary thereafter, I think it is understood that probably TCS would end up talking about 15 to 17% kind of a growth going forward, whereas Infosys has talked about 7 to 9% kind of a growth in the 14-15 financial year. So from that perspective, I think the market has corrected. I don't see, I think, too much of a downside for Infosys. Maybe I think somewhere at 3,000, 3,100 level, if the stock price comes down to, then probably you would see the allocation of funds coming into the Infosys with a target upside of around 15 to 20% in following 12 months.
Deven, we've got Reliance as well coming out with its earnings over the long weekend. What is it that you're expecting this time?
Well, in case of Reliance, I think the earning estimates are likely to be more on the positive side, also from the fact that this last quarter you are also likely to see the contribution of Shell Gas getting reported, and more importantly, I think in the retail space, I think the company has already started making profits. So these two portfolios are likely to contribute smartly to the bottom line of the earnings of the company. All along, I think we have also been seeing the traction on the distillation side in the refining business, and that's where I think you are likely to see the higher amount of refining margin in this particular quarter. So all in all put together, I think the company would end up with the year somewhere around 67, 68 rupees earning per share as we calculate, I think, in this particular times. And maybe we'll have to wait and see as to how exactly they give the commentary pertaining to the petrochemical segment of the business, which is likely to start some of its capacities in financial year 14-15 in the second half. And that is a trigger, because that's where the company would probably start recording the volume-led margin growth into petrochemical segment. So overall, I think it's more of a commentary as far as I think the future of the 14-15 financial year is concerned. Most of that I think is priced in, though, as I would call it. But growth would be seen largely from the Shell Gas. So I think these are the few areas which one would like to look at in case of Reliance's results.
Deven, even though it may be yesterday's headline, United Spirits as a stock is going to be a big one now. Do you think United Spirits as a stock has a long way to go, even though Diageo has given a very charitable open offer price of 3,000 plus. Do you think the stock has a long way to go?
Yes, Nikunj, I think it's a handsome price offer. I think as somebody may want to probably encash it, I think for the short-term gains, I think it's a very nice price offer that one could talk it out. Diageo taking the management control of this particular company and running this show, I think is largely the statement of growth that they are looking at going forward from this business. As the alcohol consumption starts increasing in the country due to the improvement in the life cycle in the economy, probably they are betting on that particular aspects of buying into the this company. Maybe their offer looks, I think, handsome to us, but at the same time, I think from their side, if you look at the perspective, and a smaller perspective from our side, but bigger from their side, is that they are bringing this money at a price which is, I think, a depreciated rupee. Now, if rupee shows some kind of appreciation, maybe 6 months down the line or one year down the line, if the rupee stays somewhere in 55, 56 zone, probably the decision of they brought in money at this juncture, I think, would well be justified given the fact that they brought in at a elevated level of rupee. So from that perspective, I think they have not paid very high premium from their side. Of course, I think those who want to trade for shorter period of time, I think for them it is good time to encourage this opportunity. But those who are looking at real long term for the prospects, I think that is there on the consumption side of improvement. Probably they may stay invested into this company. They are trading at a premium, of course. I think that should be remembered, and it could underperform the market for some time, at least in near future.
David, now that we're done with Infi and staring at many IT earnings to begin with, what is your own sense of how Q4 is likely to stack up as against Q3? Because a lot of experts do believe that barring an odd cement or telecom perhaps, Q3 is going to outdo what we're going to see in Q4, and Q4 will be a much rather muted mixed bag.
Well, in case of IT, yes, I think because of the extended winter that we have seen in the Western world, good amount of, I think, the disruptions due to the, I think, the nature-related disasters happening, particularly in America. So this has probably resulted into some amount of higher holidays in this country, and as a result of which, I think some part of the billing has come down for many of the IT companies. That could have influenced or added, I think, some part of the cost also into the books, which will get validated, I think, once we see the results coming out. But to my mind, I think if one has to look at the companies beyond a quarter, then in such situation, I think you are seeing a higher amount of potential coming up, because in America already we are seeing the improvement. In Europe, I think there are early signs of, I think, improvements which is being talked about, and many of the IT companies are expected to show some better amount of performance coming from European side, because many of the European companies for the first time are basically, I think, asking for higher amount of outsourcing, and that's where I think some of the Indian companies could possibly, I think, register bigger growth. I wouldn't be surprised if likes of TCS could start talking about receiving some of the large ticket orders coming in from the European territory in excess of $1 billion itself. I think that could be something which one will have to look forward as far as 14-15 financial is concerned. To my mind, even though the quarter 4 may remain a little muted for many of the IT majors, I would think that I think 14-15 would be at least largely a good year for most of the IT companies. Would indeed look forward to TCS's, I think, the approach on the subject and probably growth that they are talking about. Though we believe that 15 to 17% kind of a growth should be possible for TCS in this financial year 14-15.
Okay, a very expensive stock, consistent growth rate. Just when we thought that markets were in a move to ignore quality, the stock was locked up yesterday.
Yeah, Nikunj, I think at times I think we see such kind of quality getting higher amount of premium, and that's what I think has been demonstrated by Graph Finance. We have been seeing this company, I think, moving with a steady pace. The likes of HDFC, likes of Graph Finance, I think they have been, I think, the quality franchises in the housing finance segment of the business, and that's where I think they have basically caught the attention of the investors. To my mind, I think though they are premium traded, but the more important part is they are consistently growing. The non-performing assets in the books are distinctly, I think, remaining on the lower side, and that's where I think the larger amount of premium is to a greater extent justified. Though I think if I have to buy one, I would probably wait for the market correction to get into the stock. But if I am holding, probably I think it's a steady set of appreciation provider in my portfolio, so I would stay invested into this company.
Deven, what is it that you've made of the weakness in, the consumption on us rather niche consumption / IT names like a Just Dial? Does it seem like it was a bubble which was, waiting to be burst, or does it just seem like a time-wise correction that the stock may be seeing?
Well, it could be a combination of both. I think if one has to look at the valuation for the Just Dial, probably I think one could easily start correlating this valuation with some of the Nasdaq listed companies which are internet based trading models. Out here in this company, I think it's a local search engine. It's a profitable business model, I would say, and a huge headroom for this company to go up to. And as far as I think the higher amount of business is concerned from the merchandise. So from that particular aspect, I think this company is really, I think, on a solid wicket, as I would call it. However, I think in the shorter period of time, due to the scarcity of the stocks available in the market, the investors probably allotted higher sum of money and paid the premium to this company. I guess I think this is a time correction which is happening right now, wherein probably I think some amount of profit booking is happening, wherein probably some amount of moderation in the valuation is happening. Probably I think you would find the consolidation at current levels. Till such time I think the new companies gets listed, I think additional companies get listed into this market. This company may continue to command premium, but I think it may move on the sideways zone and moderate itself. I think over a period of time it would probably start looking up. But on the quality of the business, certainly I think it's one among those which is I think profitable business, as I would call it.
For a trader, is it time to lock some gains in oil marketing stocks? The entire thesis why oil marketing stocks have done well off late is a strong rupee and a weak crude. Now it's the reverse. Rupee is stable and crude is up.
Well, I think this kind of phase would continue, Nikunj, but to my mind, I think the oil marketing companies and the upstream oil companies like ONGC, they moved up in the recent times largely based on the expectations of the NDA-led government coming into power, and they're systematically working on the subsidy part of the business, I think, which is troubling most of these companies. Because of that, I think the companies are not growing. And on that assumption, I think larger amount of money got allotted to some of these soil marketing and the upstream companies. To my mind, that part of the story hasn't changed at this point of time. And probably, I think one will have to wait and see once I think the government takes a position and take the policy actions thereafter. But to my mind, market would probably have a run-up or would have done a run-up little ahead of time. So I would think that I think some correction is justified given the kind of rally that they have had. In this correction, we might once again see the long-only funds contributing to the process and add into the portfolio of some of these companies. So I would rather remain, I think, opportunistic to buy in this particular scenario in a falling market or corrective market in some of the companies like BPCL or ONGC for that matter, or GAIL for that matter, to add into the portfolio.
Deven, do you like Jubilant Foodworks after the recent correction that the stock has gone through, and of course now that the FII limit being hiked, does it seem like in the near term it may have bottomed out?
Well, I really do not know, I think, whether in the near term it has bottomed out at this point of time. But what I'm more concerned about is the kind of a growth that this company is basically now likely to achieve. To my mind, I think they are facing the headwinds on the growth side, and probably I think that's where the company is on some amount of corrective downside as far as the price is concerned. I think till the point of time, I think we see the growth returning back with some better strategies from their side. I don't think that I think people would be in very much hurry to buy into this company. Of course, increasing the FI limit would mean that I think some amount of allocation of fund would start ending up into this particular stock, and that could stabilize the price. But to really get the premium prices, I think, which they used to command earlier, I don't know, I think, whether they could come easily till the time they bring the growth back into the business. So really watch, I think, the growth coming out, and that's where I think one could allot money into this company.
Well, competition has intensified for Jubilant Foodworks as other market players like Pizza Hut, they've become more aggressive. Same store sales are declining. Promoters have been offloading their shares in the open market. Capex is on, and the Dunkin' Donut franchise so far has not reached anywhere close to its break even. So obviously there are a lot of headwinds for Jubilant Foodworks, at least in the short term. So Deven, what is a very broad portfolio strategy which you plan to adopt in the run-up to the elections? Are you in a mood to lock some gains? Are you in a mood to buy into momentum stocks, or you would simply stick to quality and you will not do anything big in your portfolios?
Well, Nikunj, I think it would certainly be the quality. I think we would not probably change from this particular aspect of adding into stock into the portfolio. The quality first, I think, as we call it every time. However, I think the kind of a run-up has been so sharp, and probably I think most of the time in many of the companies, I think it has been discounting the future far more in advance. So what we believe is a strategy forward is that at least I think 25 to 30% of the portfolio of stocks, I think where we see the valuations are not justified or they are stretched in the near term at least, even though the underlying business quality is good, one could book some amount of profit, take money on off the table, and probably wait for the opportunity to buy into some of these companies. We have been successfully doing this in some of the portfolio stocks which we are holding, and we find that I think the market gives the enough amount of opportunity in a corrective downside to buy into some of these stocks. So I think that strategy we would like to continue going forward and not deviate from the quality selection of stocks in the portfolio.